Hello again, this is Alex with MasterChartsTrading.com, and this is market recap for Friday, January 29, 2016. Today we'll look at stocks which are extending their relief rally following Bank of Japan announcement to keep the interest rates negative. We'll also look at some of the longer-term charts of New York Stock Exchange Composite and what will it take to turn this ship around and for the market to become bullish again. Bonds are breaking out and are possibly going to challenge new highs, all-time highs soon. As expected, the US dollar is gaining against other currencies. I have an experimental indicator for gold that I would like to share. GDX is currently in the Fibonacci retracement area. We'll look at oil as it continues a bear market rally, and we'll also revisit natural gas with its possible bear wedge on the chart. All right, so this is S&P 500 ETF SPY on the daily time frame. So looks like we're getting a bear market rally off of the lows here. The support here is holding for now, and looks like we're getting a relatively strong. I think this is a short covering rally still. The reason why I think is it's a short covering rally is because I think S&P 500 is in a longer term downtrend or a bear market. So by definition, this would be a short covering rally. Um, Now, of course, this is a very nice looking bullish candlestick, and it came on the heels of Bank of Japan announcement that they're going to keep the interest rates negative. Basically, this is bullish for stocks. Um, Now, once again, lots of resistance because now, since we're in a downtrend, support is, it's kind of like we're going to be making lower lows. So it makes sense to look for resistance levels to see where a potential short selling will occur again. And of course, pretty obvious resistance level is right here at 198 and change. Also, the 50-day moving average is coming in there, and there's broken support. So this would be just a great place for S&P 500 to fail. Let me see if there is anything else in this chart. We are oversold. So this, for example, is breadth momentum oscillator. It's kind of similar to MACD indicator. It shows, but the difference is it shows it's like a version of McClellan oscillator, which measures breadth momentum. So you can see that became quite oversold and now is rising. The better opportunities to go short, of course, would be when the indicator is in positive territory and starts to turn down. Okay, so that's it for this chart. Next, we'll look at a more longer term one. Okay, this chart shows the actual underlying index, S&P 500 index SPX. The previous chart showed SPY, which includes dividends, and you can see that on this chart, we actually already broke below the low, and last week I mentioned that this is a 92-week low. With the dividends, it looks a little better. But in any case, this chart is, I'm more interested in the indicators below, and these indicators are showing percentage of stocks above the 20-day moving average, 50-day exponential moving average, and the 200-day exponential moving average. So you can see that during the bullish period, for example, here, as we were making higher highs and higher lows, oversold readings were good opportunities to buy. And once we became bearish, now we have to reverse our thinking and look for overbought opportunities to go short. So for example, this was a good opportunity right there, another good opportunity. So we're getting already pretty close to that level. We're breaking out again above the 60% of stocks above the 20-day exponential moving average. We are somewhat still oversold. because this was quite a powerful move here. So we are somewhat oversold. And once again, there are some levels to watch here around 1993 and maybe 1975. That would be potential places for this index to fail. Bullish percent index, you can see it's still very much in the bearish territory and has not yet made it even above the 50%. We're still in the 33% area. Very briefly, let me actually show you another chart of QQQ with the same indicators on it. It's a little bit weaker, surprisingly. You can see the QQQ is still only 49% of stocks within QQQ are above the 20-day exponential moving average. So, that's actually kind of surprising. There's quite a bit of weakness in the tech sector, in the technology. All right, next we'll look at New York Stock Exchange Composite. All right, this is New York Stock Exchange Composite NYA Index. I showed this chart in the past, and this chart shows basically four indicators. So we have here moving average, 50-day moving average, and a 200-day moving average in green and red. Below here we have percentage of stocks, New York Exchange Composite highs less lows divided by total issues. So there's a percentage of stocks. New highs less new lows. Bullish percent index for NYA here in this pane here, and percentage of stocks above the 200-day moving average, exponential moving average. If we set the triggers for bearish territory, as for example here for NYHL to be -5, you could see that we went negative back here in August, and we have not been able to break above +5%. Another one is, of course, bullish percent index. This one went below the 40% mark. Here, same thing in August, and we were not able to get above the 60% mark until now. We were able to get above 56% mark, so that's as far as it went, and then we actually came back down. The same goes for percentage of stocks above the 200-day exponential moving average. We went negative back here in early August, and we were not able to even get above 50%. So all of these four indicators are showing persistent weakness in the market breadth. So if I was to change my opinion about this market, I would like to see at the very least some of these indicators to go bullish. So maybe we'll have more new highs. Hopefully we'll have a bullish moving average crossover. Maybe we'll get some higher percentage of stocks above the 200-day moving average. But for now, it looks like it's all of the indicators are pointing in the bearish territory, and I don't see improvement just yet. Of course, this can all change on a moment's notice, so we have to keep an open mind. All right, next we'll look at S&P 500, and this is my custom market breadth indicator, and I showed this chart in the past. This market breadth indicator is composed of various momentum, trend, and breadth indicators rolled into one. So I created one kind of like a digital signal indicator. We're either in a bullish territory when the indicator is hit plus 4.5 here, and we're going to remain bullish until we hit 1.5 here, and vice versa. So this indicator is actually quite useful, and you can see that it called the bear market and the bull markets very well. And I think the most important thing that I use it for is to avoid the whipsaws, false trend changes. You can see there was a bunch of them here. I think we just had one false trend change just a couple of weeks ago when the 50-day moving average for S&P 500 went above the 200-day moving average for S&P 500, but the market breadth index was firmly in the bearish territory. Now, I want to call your attention to this lower part here, which is a raw MBI, which is one of the inputs that I use to calculate the market breadth index. You can see this is the chart going back to 1997. So um, here at the end of the bear market in 2002, 2003, we had the oversold reading in the raw MBI index below the 20 mark here, and then eventually we had the markets turn around and continued higher. The same thing was here in the 2009. We had the oversold reading below the 20, and then we had a turnaround in the market. Now, for now, we have not had oversold readings below the 20 just yet. We're currently at 28.57, but to turn this, if we continue down lower, then I'll say maybe there is something happening. Maybe we're definitely oversold, but we're not yet oversold. So maybe we'll get a small rebound and continue lower as far as the stock market goes. So my bias is certainly bearish at the moment. Next, we'll look at bonds. All right, this is a TLT, 20 plus year Treasury bond fund. So today we almost broke out above these levels, about these levels here, and we gapped up at the open, and despite the fact that S&P 500 finished really strongly for the day, S&P 500 I think was up more than 2%. Bonds really held on quite well and retained their value. And this is kind of classic flight to safety patterns. And you can see TLT is now among market leaders. You can see the StockCharts technical rank is at 90, almost 99. So it's very high as far as performance goes amongst other ETFs. So this again is showing definite flight to safety. So you can see that we're making higher highs and higher lows in unbalanced volume, so money is certainly rotating into bonds. If stocks come under further selling pressure, I think we could see the depth of this pattern, which is around, I believe, 8%, duplicated on the upside. So, we could see some substantial upside still. Next, I'll show AGG, which is a diversified bond fund, which is actually performing even better. All right, this is AGG, a diversified bonds fund that contains many kinds of bonds from United States markets. So today's performance, you can see it's even better than TLT. It broke out above these levels from October highs. First of all, a big gap up, but like I said before, for TLT, the same thing. Even though stocks really gained strongly, the bonds did not drop, so did not sell off. And this is showing again a flight to safety behavior. So next chart I'll show a bit of a longer term chart for AGG, and we'll see where is it going. So this actually also showing that bonds are one of the best performing funds right now. Okay, this is same chart, or the same stock fund, same fund AGG, diversified bond fund. So this is a weekly chart going back a couple of years, and so this is a all-time highs here at beginning of 2015, and we're actually very close to all-time highs. So we're at 109.35. The all-time highs were at 109.84. It will not take a lot to break out above the all-time highs. Should that happen, maybe this is kind of like a pennant of some sort, and should that happen, this is a depth of pattern, so it could easily be duplicated on the upside. So that's another 3% up from here. Again, this is already all-time high, so we're basically challenging all-time highs. Um, Again, this is showing flight to safety behavior, and should stocks come under further selling pressure, this could easily materialize. Next, let's look at the US dollar. Okay, US dollar index daily chart. Today, Bank of Japan announced that they're going to keep the interest rates negative. In other words, they're going to charge depositors in the Bank of Japan. So this is another form of stimulation to the economy. They say, kind of like similar to quantitative easing, negative interest rates. Where is this going? It's difficult to say, and possibly we're gonna end up with some weird side effects that we don't expect in the financial system. But for now, this is bullish for the dollar, and the dollar seems to like it. And like I keep saying, back here the support held, and we're again challenging 52-week highs, which are back here. So it will not take a lot to break out to 52-week highs. Again, this is StockCharts technical rank of UUP, which is a dollar bullish fund. You can see it's also in the top 10% against other non-leveraged, non-inverse ETFs. So this is showing that the dollar is certainly performing well, and is certainly bullish. Of course, the bullishness in dollar will most likely translate into weakness in many commodities, so we'll look at the gold next. Okay, this is gold spot price daily time frame, and this is going back to 1995. This is a very long-term chart, so what I did is as I showed for the S&P 500 and my custom market breadth index, what I did is I removed the price and I only left the moving averages in place, the 50-day and the 200. Here in the upper part of the chart, I created the gold miners in an uptrend private index, and I looked at several of the trend indicators and the market breadth indicators for the gold miners. Again, I kind of tried to roll them all into one. This is still experimental. I'm still playing around with this somewhat, but for this time period, it already worked pretty well, and I can already use it basically as it is. So this chart shows that when this indicator drops below this red line, we're going to keep a bearish bias. For example, here from 6 till about 2000. Then we had a bullish crossover, but then a whipsaw and then back down. So definitely not without whipsaws. And gold miners are super volatile. Excuse me, and gold itself is actually quite volatile compared to other funds like stock funds or bond funds. So any kind of help with trading, this quite volatile commodity is certainly helpful. So another whipsaw here in 2008, and then a bullish continuation in 2009. This bear market was called perfectly by this trend indicator from 2012 and continued lower ever since. The important thing on this chart, I think, is that these pink boxes were the whipsaw crossovers for the moving averages. So you can see that this attempted breakout in 2012 was actually just a part of the bear market rally, and the same thing here. So for now, gold is still very much in a bear market, and this indicator is confirming it. Here below, let me zoom in a little bit to 2008 and further on. It's kind of interesting data. Excuse me. Let me update this. So this is a bullish percent index for gold miners, for the gold miners, and unfortunately the data is only available from 2008 on, but it's already quite useful. The only thing is tricky where to set the bias trigger. So I set it pretty high at let me see, like 78 or so, and below here actually below 20. The reason for that is because the miners, the gold miners, they're really volatile and they move kind of together in as a group. So here we can see that we had a bearish signal and then a bullish signal. So this was a really good signal, I thought. And then a bearish signal here in April of 2012 also was very good. So no bullish signal just yet. Maybe we're somewhat oversold. Maybe we'll see a little bit of a continuation of a rally, but as of right now, what I'm seeing is still quite a bearish picture for gold. Okay, this chart shows gold spot price weekly chart. So each one of those bars is a weekly activity worth of data. So here we're going back to February of 2015, and we had this, well, I dropped from here from May highs to July lows and then a rebound. So I put in this pink color, I use Fibonacci retracements, and you can see that it basically retraced just about 61.8%, which is a kind of good retracement target for any kind of security. And then it failed and continued lower, making a lower low here in November. Now again, if we take Fibonacci retracement from the high in October to the bottom here in December, we see that right now the price is right in the middle of the Fibonacci cluster of the 61, 50, and 38% retracements. So this is usually where those retracements end. So that's already like many people will just look at the retracements and just either short right there at the 61% retracement or at the 50% retracement. Right now we're exactly at the 50% retracement, so possibly people already started shorting right there. We'll see next week, of course. But another way to look at it, and actually next chart I'll show, we may still see some upside to this move from the November lows. So let me show you the next chart. Okay, this is gold spot price end of day chart and the daily time frame. This is 6 months worth of data here. So I showed this chart I believe last couple of weeks also. This could be a cup with handle pattern. And if it's indeed a cup with handle, this looks like a breakout to me above the lip of the cup. So if this is indeed a cup with handle, we could still see some upside to possibly even 1190. Now, there are tons of resistance up here, of course, from this failure, from these peaks here. So uh, unless we fail right now, this could be the next target, and that's probably would be a great place to go short. However, there's also a possibility that by then we'll see some more bullish signs for gold. Like for example, the indicator I just showed with the market breadth custom breadth market breadth indicator, maybe we'll see more upside signs and possibly we'll need to reevaluate the whole posture on the gold. So for now, I'm treating this continuation as still a bear market rally, and I'm looking for shorting opportunities. But once again, we have to keep our minds open, and maybe one day there will be a turnaround, and then we'll see, and we'll change our posture to bullish, and we'll continue, and then we'll start looking for opportunities to go long. As of right now, I'm still treating this rally as a bear market rally. Next, let's look at GDX. Okay, this is GDX daily chart. Again, this is a much more volatile security than gold itself. We had a breakdown here below the support level, $13, but then a move right back. So could this be a failed breakdown? Absolutely. Again, I added the Fibonacci retracements here in pink. So right now we already are at 38% retracement from this low and from this peak here. So maybe we'll continue higher to the 50% and possibly even 61% retracement. And you can see that this is actually even higher resistance area because there is now a peak from here from beginning of January and another peak here from December. So this area is of great importance to GDX. So if we don't fail here in the $15 area, again, we could continue higher and possibly retrace even 100% of this move. And at that point, we will need to reevaluate again. And like I just showed several charts before, we'll need to look at the balance of evidence and see if indeed the gold complex has made a turnaround. As of right now, again, this is still a bear market rally to me. Let me see if I want to say anything about this. Yeah, there's still a bit of a bullish divergence here because we made a lower low here in the price, but we did not make a lower low in the advanced decline lines. We did make a lower low in volume though. So we'll see where this is going. For now, this is still a bearish security. Okay, next let's look at oil, West Texas Intermediate Light Crude, spot price daily chart. Multi-year lows here in in mid-January, and then a bear market rally, which is a counter trend rally. You can see we already came up to this resistance from 34, around $34. So you can see that there was already some resistance and some short selling that took place here. You can see that also there is a volume by price bar that I added, and this is exactly in this area, $36, $37, $35. So also the 50-day moving average is coming in there. You can see there's a cluster of things that are coming together, and this is possibly going to be a resistance and possibly a failure area for oil. Maybe we'll continue higher. There is next resistance or high resistance area, high volume resistance, of course, is up here in $46 area, which is also where 200-day moving average is coming in. Between the two levels, there is not much as far as volume is concerned. There's this bar here at $42, and of course, you can see there was a wedge breakdown. So there are tons of resistance up here, so it will basically be watching for the signs of failure. Again, I'm not trying to pick bottoms, so this is a bearish security because we just hit multi-year lows and it's in a downtrend. Next, let's look at natural gas. Okay, this is natural gas spot price end of day daily chart. So again, this is pretty clear. A strong drop, multi-year lows, counter trend rally, failure at resistance, and a breakdown again. This could be a rising wedge, even with 2 days worth of pretty strong price action. I still think that we're not yet out of this bear wedge formation. So maybe if we break out here, then maybe this bear wedge will no longer be in play. I still think it's in play, so if we do break below, I don't know, maybe 22.1, right around here, then we can easily see a retest of this multi-year lows. Now, a couple of things I want to say about natural gas and commodities in general. They are very volatile. So, I compare trading these commodities kind of to riding a racing motorcycle. It's super exciting, but at the same time, it's super dangerous. So you have to basically size your positions correctly, and if you do sign up for my trading alert services, you get access to various videos on risk control, etc. So again, this is a something to think about. But for now, this rising wedge I think is still in play, and a break below maybe around here will open the door to a retest of multi-year lows. An alternative scenario, of course, is a continuation higher, and there is resistance up here now in the $2.5 area, and the 200-day moving average will provide resistance as well. So I wanted to show you how to find us on the internet. Please go to MasterChartsTrading.com. We do have a trade alert services that are now active. Please consider subscribing. You get 3 weeks free trial, and it's only $24.95 per month thereafter. You get access to my charts, exactly what I'm buying, exactly what I'm selling. I have an internal blog. Also, I have several videos that have to do with trading and various aspects of um, risk control, as well as just the psychology of trading. So please do consider signing up. The subscribers are getting really good results, I think, and I'm getting some very good feedback. I have a performance section here where I post the actual portfolio percentage change. The inception date was in 2015 October, so it's not a lot of history yet. And there's some backtesting results that I feature here as well. The blog, of course, is where you'll get this information, and there's a video section where I separate them out for easier access. Click on the social page, and here we have a link to public charts page where most of the charts that you're seeing in this video are going to appear. If you have Twitter, Facebook, YouTube StockTwits accounts, you can find us there as well. If you subscribe to our mailing list, you'll get a special price for our trade alert services. That's it for watching. Thanks for watching, and have another great trading week. Bye bye.